We are in Cracker MCQ series for BFM. Presently we are in module B. And the topic is objective questions on market risk in banking. Day before yesterday I had covered credit. Yesterday I had covered this operations, and today we will be covering the market risk. So very important topic. Watch the video till the end because it will be of great help to you in your exams, because module B is the most important topic in BFM. Okay. Firstly, download Adda 24/7 app on your mobile. In this app, you will be getting all the premium study material, current affairs, job alerts, daily quizzes, live video lectures, plus notes, tests, everything whatever we need for CAIIB, JAIIB and various exams. You will be getting it. Okay. Also, subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the updates, all the updates, latest updates for JAIIB, CAIIB and various other banking exams, right? Also, you will be getting the free YouTube series on this. Now, this is whatever is free available in the market. I think we must first grab it. Okay. So, subscribe to it, click on the bell icon. Now, this is a new batch. Okay. New batch for CAIIB just now started. ABM, BFM, ABFM and BRBL, all the 4 subjects, numericals, objective questions, everything, and huge discounts are going on now because of the new syllabus we have brought in this series. Okay, this discount series. So 80% off is going on and double validity on the Mahapack. Definitely go for it. Okay. Yeah. There was one question for homework. The question was, liquidity risk of the bank arises from, means from liquidity risk from for the bank arises from which due to which segment. So what were the answers? Funding of long-term assets by short-term liabilities, funding of short-term assets by long-term liabilities, funding of long-term liabilities by short-term assets, and none of these. So what was the answer? Many of you have typed it. Yeah. Let me see. Okay, let me explain you first. Say this. Suppose if I am having, let's say, keep it very simple. I am having a loan of, let's say, loan, okay? Loan, and then I am having an FD over here. Let's keep 1 to 1, okay? And the loan is, let's say, 1 lakh. Both are of 1 lakh only. 1 lakh over here. I am having an FD of 1 lakh, and against that, I am giving a loan of 1 lakh. Okay? 1 lakh to 1 lakh we are matching. Now what happens? Let's say this FD is of 1 year. And this loan is of 3 years. So will I face a funding risk? Yes or no? Type yes in the comment section if you feel we will face a funding risk over here. Type yes in the comment section. Will I face? Correct. I will face, because this FD person will come to me after 1 year for withdrawal. And I am not having this money. Why? Because I have given a loan for 3 years. So that's why yes, there will be a liquidity risk over here. Liquidity, I'll just write LIQ. Yes over here. Okay, tick mark. Now second case, I'm having a loan of 1 year against an FD of 3 years. So will I face a liquidity risk over here? Because this person will come to me after 3 years, and when will this loan person repay me, or the borrower repay me? Within 1 year. So will I face the liquidity risk over here? Type yes in the comment section if you feel yes, or no if you feel no. Type fast. Yeah, correct. The answer is no. So what is the answer? Correct answer to this. Funding of long-term assets, see this, long-term assets by short-term liabilities, that will always create the liquidity risk. Okay, got the answer everyone? So the answer is A. Got it? Next one. Funding liquidity risk is defined as, means what is this liquidity risk? Just now we saw this liquidity risk. What is this liquidity risk? Excess of liabilities over assets, excess of long-term liabilities over long-term assets, excess of short-term liabilities over short-term assets, inability to obtain funds to meet the cash flow obligations. In fact, I would say E. Let me mark it E. All of the above. All of the above. Now you type the answer. What do you feel is the correct answer to this? Means funding liquidity risk. What is the liquidity risk? Where am I facing the liquidity risk? Excess of liabilities over assets. Let's keep it simple. See here, I am having assets over here. In the balance sheet, what do we have? Assets over here, liabilities over here. If my liabilities are 10 and my assets are 5, so will I face liquidity risk? Assets mean they give me money, right? Assets means they give me money, and liabilities means they take my money, right? So if I am having liabilities more and assets less, will I face the liquidity risk? Yes, I will face. Excess of long-term liabilities over long-term assets. This is also correct. Long-term liabilities are 10, long-term assets are 5. So I'll face the risk. Excess of short-term liabilities over short-term assets. Again, this is correct. Why? Because if I'm having a short-term assets of 5 and short-term liabilities of 10, then I'll definitely face this liquidity risk. Inability to obtain funds to meet the cash flow. That is a basic thing. Means all these three, A, B and C, will actually result in D, right? Inability to obtain funds to meet the cash flows, because wherever I am having lesser assets versus bigger liabilities, I'll definitely may face the cash crunch, isn't it? So the correct answer is what? A, B, C, D or E. Which one is the correct answer? Type fast. Correct answer is E, all of the above, correct? Yeah. Liquidity risk in banks manifests. Why am I talking of liquidity always? Because liquidity risk is a part of market risk. Yes, here. Our topic today is market risk, right? Market risk always has, market risk means which is not in your hands, okay? So definitely it has liquidity, okay? Then exchange risk is also a part of market risk, okay? Exchange, and these are the two main. There are many others, but these are the two main, okay? So liquidity risk in bank manifests in different dimensions. Which are these? Means manifest means comes, okay? So liquidity risk is of various types. It's simple question. Liquidity risk in banks is of various types. So which are these? Funding risk arises from need to replace net outflows, withdrawals, non-renewal of deposits. Means I need some funding. If my net outflows in deposits are more, means what? Suppose if my customers are withdrawing my deposits and not renewing it, so I'll be needing the funds for the loan. Let's say, let me show you over here. These are assets, right? And these are liabilities. So deposits and loans, okay? So loans are of, let's say, 1 lakh, okay? 1 lakh. And I'm having two deposits of 50,000 each, 50k and 50k. So what have I done? I have combined these two deposits and funded the asset of 1 lakh. Now what happens? This person of 50,000, he withdraws it. This person, he or she withdraws it. So now I am having only 50,000, but my assets are 1 lakh. So what will I need? I'll be needing fresh funds, fresh inflow, right? So I'll have to borrow, okay? Fresh inflow, I'll call it, okay? So that can be through borrower, that can be through any other means, okay? So I'll be needing fresh 50k in that case, okay? So that is meant by the A option. Funding risk arises from the need to replace net cash outflows due to non-renewal of deposits. Time risk from the need to compensate for non-receipt of funds. This is also an important part. Suppose, let's say, this 1 lakh asset, this person becomes NPA, okay? NPA. Now these two guys with 50,000, they'll come to me for withdrawal. At that time, from where will I give the money? Because this asset has become an NPA. So compensate non-receipt of funds due to NPAs, right? Or even if they are not NPAs also, then also, suppose if this asset is of longer term, liability is of shorter term, I'll definitely face the cash crunch, isn't it? Third one. Call risk arising due to crystallization of contingent liabilities. Means, what are my contingent liabilities? Contingent liabilities means my that LC, bank guarantee. These are the two main. Court cases. These are the two main actually. Okay. So crystallization means these organizations to whom I have given the guarantee, these organizations come to me for for asking for the money. Right? Means, suppose example, I have given this guarantee on behalf of my client to, let's say, municipality, okay, local municipality over here. And what happens? This client does not perform. He was to build some every road construction, something like that. Okay. Now that client does not perform, so this municipality will come to me. So this is known as crystallization. When actually the non-funded asset becomes a funded asset. Okay. So what is the correct option? Liquidity risk arises is of which types? So funding due to replacement of outflows, funding due to time NPS, A and B, or this C, or either of these. So the correct answer is, everyone, it is A and B. Correct answer is D. Why? Because this crystallization of contingent liabilities can't be a credit market risk to me or liquidity risk, because I already know that I have given the guarantee. It means I have to keep that money aside. So that's why if I know this, risk means what? When I don't know something is going to happen. But here I am knowing that there is this, it might come down to me someday asking for the money, right? So that's why the correct answer is A and B. Where an asset maturing in 2 years, liability risk will be, means if an asset is maturing in 2 years, whenever I am having, let's say, a deposit which is maturing in 2 years, so what can be the risk to me? Basis risk, yield curve risk, gap risk, embedded option risk. Now what is basis risk? Basis risk means change of the rate of interest in different ranges for an asset and a liability. Means if, let's say, my loan rates are changing by 1%, loan rates are changing by, let's say, 1%, okay, and my deposit rates are changing by, let's say, 2%, then this is known as a basis risk. When both of them change with the same ratio, then there is no basis risk. So basis risk means the interest rates of loans and deposits change in different magnitudes. Okay. Next is yield curve risk. Yield curve means basically, see here I have shown you all the 4 types of yield curves. Okay. Normal yield curve, then inverted yield curve, then flat yield curve, right? And last one is what? This normal yield, camel humped. This one, isn't it? These are 4 types of yield curve. We have done a separate session on this. Yield curve risk means what? When there is a recession, this yield curve becomes inverted. This is a normal yield curve, means economy is growing correctly. So yield curve risk means what? Does this asset is maturing in 2 years, will this affect the yield curve? No. Okay. Gap risk. Gap risk means what? There is a gap between the assets and liabilities. Okay. Means funding of assets and liabilities. So when asset is maturing in 2 years, I know that asset is maturing in 2 years. So basis risk won't affect me at all. Why? Because the rates are already fixed. Now let them change by any magnitude. I have already given the rate on that FD, right? So it won't. I won't be facing this risk over here. The main risk which I will be facing is, what is the option? What do you think should be the correct option over here? Correct option is embedded option risk. What is this embedded option risk? It means non-renewal of FDs or premature withdrawal. This is also an important part. Premature. If this customer comes to me for premature withdrawal, in that case what happens? I'll be facing with this risk then. Okay. So whenever an asset is maturing in 2 years, the main risk will be embedded option risk. The risk of adverse variance of mark-to-market value of change in market prices in the interest rate instruments, equities, is called as, what is this? Mark-to-market. What is this mark-to-market? See here, always remember, every bank or every treasury has 2 books. One is banking book, banking, okay? Book, we'll write it, banking book. This is main part, okay? This is very important part for you in treasury. And second is trading book, okay? Trading book. Always remember, in banking book I buy those bonds which are not to be statutory bonds, which are not to be sold. So bonds not to be sold, okay? Which are those? The bonds for CRR, okay, SLR. These bonds are bought by me in banking book. But what is trading book then? Trading book is the bonds which are to be sold. To be sold. I'll write it only this much now. To be sold. I'll buy the bonds which are to be sold over here. Means I'm buying these bonds for profit, not for the compulsory statutory requirement. Okay. So my mark to market means what? If the rate changes of the bonds, okay, let's say the bond rate changes drastically, so this banking book won't be affected. Why? Because I don't have to sell them. anything market price of any bond is affected, it affects the bond if I have to sell them. Here I don't have to sell them, but here it will be affected, right? So now the adverse movement in the mark to market value of the change in market price of the interest rate instruments equities is called, so price risk, market risk, translation risk, and both A and B. Before that, I'll explain you what is translation risk. Translation risk means basically bringing the notional profits from my outside branches, means outside India, foreign branches, to my balance sheet in India. Okay, means SBI New York, SBI USA, let's say, why New York? SBI USA, okay. SBI is having branches in USA also, and SBI India. So when 31st March arises, okay, this SBI USA's balance sheet is the net figure of that, net figure of this SBI USA balance sheet is brought to SBI India, and then SBI India reports the whole figure to RBI. So for reporting to RBI, it will have all the SBI USA, UK, all the branches from various countries, and the net figures will be shown over here. So this is known as the translation risk. But what is this? Is this related to this mark to market? No. Means adverse variance, risk of adverse variance. So is this actually affecting it? So no. Basically here, market price, we are only talking of prices where I am selling something. Okay. So here if I am not selling something, so translation risk won't be affected. It's just a notional thing. Whereas price and market risk are the actual things. Price risk means the price of my bond goes down, so I'll actually face the losses. Market risk also here same logic, means I'll face the losses. So the correct answer is both A and B. Got it? Which of the following is not a market risk? Compliance, transaction, legal, and all of the above. So which of them is not the market risk? Not. Okay, what is market risk? Market risk means which is not in your hands, not in your hands. That is basically market risk. Okay. So is compliance in my hands? Yes. Why? Because after all, I know what are my RBI guidelines. I have to just follow them. So is it a type of market risk? No. Transaction risk means what? Transaction means errors in the transaction. Can this be avoided? Yes. How can this be avoided? I can follow the maker checker concept, 4I principle in the banking, right? So this way, if you want some serious, the transaction is serious, you can apply the 6I principle. Go ahead of 4I principle, right? And you can avoid this transaction risk, means errors in the transactions. So is this a market risk which is not in your hands? No, this is in your hands, it can be avoided. Legal risk. Again, it's a part of operations. Here, all these three are operational risks. Okay. Why? Because legal risk means for documentation risk. So documentation, again, it's in my hands only. When I do any agreement with somebody, or as a bank I do an agreement with somebody, I must see to it that what are the legal provisions in that country. Suppose if it's in foreign country, then what are the legal provisions of in that foreign country, right? So that I need to follow. So that's why it's again a part of operations risk and not a part of market risk. So correct answer is what now? Type fast. What is the correct answer? A, B, C or D? Obvious, isn't it? D. Got it? Country risk is an example of. Country risk means what? Market, credit, operations, liquidity. Country risk is an example of what? What do you say, guys? Okay, let me show you. This credit risk, okay? Credit risk has two types. Always remember this. Credit risk has two types. Risk, I'll write it. Risk has two types. What? One is, now you'll get the answer. Country risk. And second is counterparty. Always remember, credit risk will always have two types only. Country risk and counterparty risk. Okay. So market risk, it's a different ball game altogether. Okay. Similarly, operation risk. Okay. So now credit risk will always be of two types only, country and counterparty. So now country risk is an example of A, B, C or D. Which one? Correct? Obvious? C. You have got this point. Everyone, I'll just wait over here and everyone like the video. Like it fast. Okay. If you have understood the questions up till now, type yes in the comment section. Everyone, I'm just waiting over here. Type yes in the comment section if you have understood it. Okay? Yeah. Click on the bell icon. Subscribe to Officers Adda 24/7. Click on the bell icon. Everyone. Okay? Yeah. So all of the following are types of price risk, except means price risk means what is related to lowering of prices. So which of the following are the types of this price risk, except we want it. So we wanted no, which is not the price risk. Okay. So commodity price risk, is this a type of price risk? Means will I be affected if the commodity prices move against me? Yes. So it is the type of price risk. Exchange rate risk, will I be affected if my exchange rate moves against me? Mean dollar rates moves up, will I be affected? Yes. Stock price risk, so will I be affected if the stock price goes up or down? Yes. Counterparty risk means what? Just now I gave you, right? See this. Credit risk is a type of country and counterparty. So which of them is not a type of price risk? Is this only? So it is no, because counterparty risk is a type of credit risk. Got it, everyone? Now one for your homework. Okay. In the financial market, bond prices and yields are inversely related, directly related, inversely or directly, depending on the type of the bond, and none of these. So what is the correct answer? Type in the this comment section. Also check on the Google if you want. Check out in the earlier lectures which I have taken. Okay. Now let me talk about this batches. Okay. This batch of ABM, BFM, ABFM and BRBL, all the 4 subjects are taken. Okay. Case studies, numericals, objective questions, everything is there. Okay. Also important part, 80% off is going on right now. How to use this 80% off? I'll show you. Okay. Let's go to Adda 24/7 live. Okay. Let me bring in the site. Okay. Yeah. Let's go to Adda 24/7 live. So this. Now we are on the site. Okay. Now click on JAIIB and CAIIB. Go on the main website. Click on JAIIB and CAIIB. Click on CAIIB 23. Now you'll see the batches. See this. These are the batches, right? So just now this January 23. Just now started the batch. Click on this batch. Now you'll see the details over here. Check all the details. Details means what? What are the bank timing? What are the timings? What are the dates? What is the study plan? Everything you'll be getting it over here. Okay, go through it at your ease, everyone. Okay. Now I'll cover the 2 important points. Recorded videos 24/7 are available anytime. It means what? Suppose if you miss out on any recorded video someday, then definitely you can go for it again in the recorded session. Also the classes are 2-way interactive classes. Means you can ask the doubts there and then itself. Okay. Now let's look at the fees. 23,999. Click on view offers. Put the code Y432. Click on apply. Now look at this. 23,999 reduces to 4,799. 80% off you are getting. My God. 80% off is a good, very good proposition which you have got it. It won't remain long. Okay. So go for it immediately. And 80% off means what is this? 23, almost 24,000 reduces to 4,700 roughly, 4,800, right? So use discount, go for it. I would suggest also you can go for the Mahapack. In Mahapack what happens? You get multiple batches. See this, JAIIB, CAIIB, Mahapack. Go to the front page, JAIIB, CAIIB, Mahapack. Okay. Now click on this CAIIB ka Mahapack. The advantage to this Mahapack is you get multiple batches. Multiple means how many multiple? Look at this. That also I'll show you. Since multiple batches means you get 15 plus batches for ABM, BFM, ABFM. My God, 15 plus batches for the 4 subjects. Okay. Also you get the recorded sessions for all the electives also, whichever elective you choose. Okay. 15 plus full length mock test you are getting it. So that's a good advantage. Now you can read it. Okay. Question banks are available, tests are available, everything is available. Now important part over here is, look at the fees part, 35,996. Of course recorded videos are available. Okay, click on the view offers. Now put the code. Now look, something advantageous to you, Y432. Now look at this. Okay, look at the validity. Validity is 12 months now. So remember, this won't last for long. It's an offer going on. Okay, 80% off and double validity. It won't last long, so that's why I would suggest go for it immediately. Fees is 35,996, reduces to 7,199. Now what is this? 7,200 almost, right? And for 12 months. So if you divide it per month, it comes to around what, 600? Yeah. So it's the best, right? That's why go for this immediately, because this offer won't last long, for longer period. Okay, I'll be back tomorrow with another session. But why am I stressing on these batches? Remember, look at the new portion which has come up, because it's a tougher portion now. Okay, it's not that simple. See here, there are 4 subjects: ABM, BFM, ABFM and BRBL. Even the elective, there is no retail elective now. Now there is HR, IT, central banking, risk. Okay, these 4-5 elective, rural. So 5 electives are there, but there is no retail elective. Also negative marking is removed now, so that's a good sign. Okay, but you have subjective questions. This is an important part. Subjective means you'll have to write the answers. Okay, this is an important part over here. Okay, they'll be providing with you with the material, but remember, subjects have gone tougher now. So that's why join the batches ASAP and use this offer as much as possible. Bye.